Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Today we're talking about commercial property. We've mentioned the sector plenty of times on Fear and Greed, and a few weeks back we talked about the surge in interest from retail investors looking for alternatives to residential property. Now remember, this is general information only and you should seek professional advice before making investment decisions. Burgess Rawson is the largest privately owned commercial real estate agency in Australia. Every 6 weeks or so they hold a portfolio auction where they sell everything from fast food restaurants and service stations to car dealerships and childcare centres. Ingrid Filmer is the CEO of Burgess Rawson. Ingrid, welcome to Fear and Greed.
Thanks very much for having me.
So what sort of commercial property are we talking about here? I gave you a few examples, food, restaurant, service stations and that. We're not talking about big office blocks here, are we?
Yeah, so we sell in kind of 10 key categories. And yeah, they start from, obviously we sell more childcare and fuel than any other agent, but we also sell, we're focusing on leased investments. So we do a lot of medical and our medical and social infrastructure. So that includes things like vets and dentists. And we generally sell anywhere from as low as 350,000 up to 100 million. In our auction, we auction between the 350 mark, and our largest auction was 22.5 million under the hammer.
Wow. Okay. So what's that market like at the moment?
Well, it's actually been really interesting. What we see is that with greater volatility, people turn to bricks and mortar. And so whilst we have seen a shift in yields, it has been nowhere near to the same extent as the interest rate rises. And I'll give you an example. We've seen fast food yields actually stay stagnant over all of the interest rate rises. So they're still sitting at around low 4% yields, despite the rises. We are seeing a lot of interest from residential investors coming out of residential. And, the stats are showing that we had the largest exodus of residential investors and the lowest level of investors looking to buy residential investment property. And that, in our mind, is very much driving our $1 to $4 million market. Within our auctions, we sell a whole range of price and a whole range of different types of leases. But we are seeing a lot of private investors very comfortable with that range where they're getting a long-term lease and where they identify with the retailer. So, if they know that it's a pet barn or, a Dental One, we're seeing a lot of confidence and a lot of activity in that market.
Okay, so they buy the commercial property for, let's say, $4 million for argument's sake. They know that there's a 10-year lease to Pet Barn or some other organisation like that. And just the fact that it's bricks and mortar, which they're used to because they've owned their own homes or investment homes, they're becoming increasingly confident getting into commercial property that way. Have I just kind of summed up what you've been saying?
Spot on.
Okay. So what makes a good commercial property investment? So I understand the process. What makes a good one? What should I be looking for?
Well, each industry is slightly different. So you need to be obviously industry specific. In general, it's definitely the quality of the lease, the quality of the tenant, and the location. So in the situation of fast food and fuel, the tenants themselves are major ASX listed companies who do extensive research into the sites that they want to be located in. And that gives buyers a lot of confidence. Often they're corner sites with dual access. So location is one part of it. However, if, for example, we take fuel, the differential between metro fuel and regional fuel is some 50 basis points because people are actually looking for the tenant and the lease covenant. So they're looking for quality leases in there so far as their net, so the tenant pays all the outgoings, especially where a tenant is ASX listed. That definitely drives a premium. And so I suppose it's giving security. The other thing we see with bricks and mortar is obviously if you have shares, every day you can see what your shares are worth. Whereas with property, you don't have a realisation of value until you come to sell it. And generally, we see a much longer ownership arc with commercial property. So most people at auctions are buying the property for anywhere from a 3 to 10 year horizon.
Stay with me, Ingrid. We'll be back in a minute. My guest today is Ingrid Filmer, Chief Executive Officer of Burgess Rawson. So what's happened with rising interest rates over the last 12 months or so? What have you seen in the market? You just mentioned yields on some fast food outlets, so that's yields for the investor, have remained at 4% or thereabouts, notwithstanding that there are higher interest rate payments. Generally, though, what has happened as a result of higher interest rates?
Well, generally, we've seen a very, very small shift in yields. So from our December auction, where we did about $77 million worth of stock across 38 properties, to our March auction, where we did $91 million, our yield in December was 5.33, but our yield in March was 5.57. So there's been very, very small shifts in average yields. And I think that talks to that investors don't necessarily see, long-term excessively high interest rates. And also because they're borrowing often at a 65% or even lower LVR. And so the rental payments more than cover the interest payments. So that makes a difference as well. But generally, not a great move. Now, having said that, what we focus in on is our 10 key categories: long-term leases, leased investments, generally to recognise tenants. So I don't think that this necessarily would relate to, say, a clothing shop in a high street shopping precinct. Those yields, I think, have definitely pushed out. And that's also led to a lot of reduction in stock. But, for example, with fuel supply was at the highest levels it had been in Q4 last year. It came down in this first quarter of 2023. And as a result, yields have actually returned to their 3-year average. So interest rates, in fact, have not affected fuel and fast food and medical yields really at all.
How often does it, when you talk about fuel supply, I'm assuming you mean a service station available for sale.
Yes.
What are the more popular properties that you sell? Service stations, obviously, being one.
Yeah, service station, definitely. Childcare. So in a general auction portfolio, we would bring, I think this portfolio, we've got 5 childcares, 4 fuels, 3 to 5 fast foods. So, but then again, we also sell things like banks and Centrelink and a whole range of different types of property. And then we also sell a lot of, Bunnings, which always draw a lot of attention. So, yeah, we sell a whole range of leased investments and generally recognised leased investments.
And something you mentioned a few minutes ago, was the LVR, the loan to valuation ratio, being 65% or below. So what that means is that it's kind of people aren't taking out huge loans, or at least loans that cover all of the cost of the building. They're actually got a fair bit of equity in it before they start.
Correct. So, generally commercial loans were sitting at about 65%. That has been a change with the interest rate. So with the interest rate rises, we've seen banks have a lower appetite for LVRs, and those LVRs have contracted to probably more like 55 to 60%. Now, what that's done, though, is not necessarily moved yields and returns on property, but it has shifted the dollar quantum that people can invest. And so your investor who was buying for $8 million might now be buying for $6.5 million, but that investor is still buying at similar yields to pre-interest rate rises. So LVRs have a major play on it. But the other side to this is self-managed superannuation funds. And that's obviously been a very hot topic lately. But a lot of our investors are cash investors using self-managed super funds. So then they're not affected so much by LVR. What they're looking for is long-term safe returns in something that they can touch, feel and see. And COVID was a huge part of that. People really returned to those grassroots concepts of investment, touch, feel, see. They also, especially in Melbourne, looked for essential service investments. And we sell more essential service investments than any other agent because obviously they could trade during COVID. And so essential service during COVID are now seen as pandemic proof and often recession proof coming into this next stage of the market.
Okay, so if I want to get into it, no, not me, someone else wants to get into this, obviously give Burgess Rawson a ring. But just before that, the 2 or 3 things that they really need to think about when investing in this end of the commercial property market.
Number one is be ready. So the difference in shares is that you can always go on tomorrow, buy some Macquarie shares or buy any ASX listed share. The difference in commercial property is there is one. So there is that one opportunity. And if you're not ready, then you could miss it. And it could be the opportunity that perfectly suits your investment needs. So I would say be ready. Understand how much money you need, how much money you have, what kind of returns. I think also read the lease. The amount of investors who don't necessarily read the lease, understand your tenant's obligations and what's required. And the other thing I think is be open to location. We sell an incredible amount of leased investments in regional areas, and these regional areas are underpinned by substantial industry, high employment levels, great low housing pricing. And that makes for a great investment and for a great tenant to outperform in regional areas. So I think that being open to a varying amount of locations rather than to saying, unless I can actually touch, see, feel it in my own suburb, investors now need to think, far wider. And they can also access stamp duty savings, for example, in South Australia. So a lot of our investors now, are spreading around their land tax liability and also seeking out better tax policies like South Australia when they're deciding where to buy.
Ingrid, thank you for talking to Fear and Greed.
Thank you for having me.
That was Ingrid Filmer, CEO of Burgess Rawson. This is the Fear and Greed Daily Interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.